Hi, good morning. You're watching BloombergQuint. Now, as you already know, smart money everywhere in the world is chasing sustainability objectives. A third of total assets under management worldwide, according to one estimate, are linked to sustainability investment objectives. But India is lagging this ESG trend. Through the last 12 months, rather, we've seen several new mutual fund schemes launch in the ESG space. There are 8 so far, with assets under management of just over 12,000 crore rupees. That's really a very small number as yet. So, are ESG investments in India ready for exponential growth as we are seeing worldwide? When do we see the smart money starting to chase these sustainability and governance objectives? Well, to discuss that on Talking Point this morning, I have with me Chirag Mehta, Senior Fund Manager of Alternative Investments at Quantum Mutual Fund. Chirag, thanks very much for joining us here on BloombergQuint. I know you started, or rather Quantum started its ESG fund way back in 2019, so that's a bit ahead of the curve. But even now, ESG assets under management, as I just pointed out, are still very, very small. And though some of the newer schemes have launched over the last 2 years, we've seen assets grow to, let's say, about 1,000 crores to 2,000 crores for SPI. It's a very tiny number. Why do you think that is?
Yeah, sure. Given that it's a new concept overall, if you look at ESG as a space, I don't think many investors are familiar with the terminology or how that works. So probably they are waiting to understand a bit more. They are waiting to see the track record, because it's even with our track record, which is 2019 old, it's just about 2.5 years of time frame that it's completed. So maybe probably they're waiting for a kind of 3-year track record, and they will jump in then after seeing the evidence that it really works. Second is the disclosure requirements around ESG are not that high. So once that disclosure requirements for ESG kick in, investors will get much more broader understanding of what the fund is doing, what are the risks, what are the opportunities, etc. And therefore, that will instill more confidence for them to come in that, yes, it is for real, and that we should participate in this. Another factor that usually drives ESG any participation is institutional participation first, and then the retail participation. Given mutual fund cater to largely the retail end of the curve, we'll see more foreign investors come in with the sustainability mindset of investing. So once that starts and once that becomes bigger, I think retail demand will also follow that. So overall, I think the pieces of the puzzle are coming closer. And I think we are on the cusp where we see increased participation from investors.
Chirag, you speak of disclosures. Now, I know this is a challenge world over to get standardized disclosures on ESG, to make sure that you're not being greenwashed as an investor. And that applies as much to you as a fund manager as it would apply to any retail or institutional investor, either investing directly in the markets using the ESG theme or through one of the many schemes available. But in India, we've been reasonably, if not ahead of the curve, alongside the curve when it comes to disclosures, right? Like SEBI already has the business responsibility and sustainability disclosures that are required. They're not mandatory yet. And most large companies have already started making disclosures based on any one of the 4 or 5 global formats that are available. So why is disclosure such a big issue? Or is it that there is really no differentiation in schemes between ESG schemes and some of the other, sort of the multi-size schemes or the multi-asset schemes that are available? That is what is the biggest problem here.
I think it's twofold. One is if you look at the disclosures, still we are seeing much boilerplate disclosures from large set of companies. We need to see those granular disclosures that will help us, take a better gauge on the company. Second is the verification or assurance mechanisms are missing. So we go beyond, talk to companies, talk to stakeholders within the ecosystem to try and verify that information ourselves. And then that is what it takes currently because of the non-standardized nature of disclosures. So once the SEBI mandate kicks in, I think we'll get much more data from the companies, which is much more standardized. So that's a welcome step, and that will go beyond and help us evaluate companies. Second is what you said about how the fund houses treat each of the ESG scheme versus the non-ESG schemes. what we believe is ESG schemes need to be true to label, right? So when we say that ESG needs to be given priority. So there are various approaches that the fund houses are using for ESG. One is to take ESG as a minimum threshold, and then something else does the heavy lifting in terms of the portfolio weights, gets decided by some other factor. What we do at Quantum is we do give ESG the priority. The weight of the company is more in sync with the ESG score of that company that we evaluate, because it's more proprietary that we do, and therefore that is how we have built it. So ESG gets a priority in our approach, whereas some other approaches, there are mixed of approaches. There is best in class, there is integration approach. So given that there is a lot of differentiation amongst the schemes, the disclosure requirement that will come in for the products will also even help investors understand what each of the fund houses is doing, how they are different from the traditional schemes. And once that comes in, I think there will be much more confidence, much more understanding available for the investor, and therefore they can take that call.
How do you score companies on ESG?
So we have a proprietary methodology that we developed since 2015. We do look at the materiality aspects of each company in which they operate, in the sector that they operate. So what's material to them? And we have different scores for E, S, and G, where governance get a much higher score, because without a great governance, you will see shortcomings on E and S as well. So we have kind of developed it, tested it, went through a learning curve, and then developed the ESG scoring mechanism. And I think given the evidence that we kind of weigh ESG as the main ingredient in terms of weighing or designing the portfolio weights of the company, in the real world, when we have kind of used it, I think it's worked well for us. The sustainability being the driver of returns, that has worked really well for us, because if you look at the performance, I think it has done better than the traditional market cap weighted indices, and that really tells you that ESG does work in the real world. So it's a short track record. It has gone through a cycle of its own in terms of because of COVID, we saw a down market, and then we saw an up market. And each of the phases of the market, the fund did better than the traditional cap weighted indices. So that tells us that our methodology of scoring companies is working well for us. And we do have a very granular approach. We kind of, for each company, we weigh about 200 to 250 factors, the data points, and then we subjectively evaluate each of the data points. So that is where the essence lies. Today, it is more subjective, and therefore, how you evaluate each of the factors is very, very essential.
But it's always going to be subjective, right? So a couple of quick follow-up questions. Firstly, your fund size, I believe, is only about 50 crores, if I've read that correctly. Yes. It's still very small. I'm not comparing it with, let's say, an SBI, because that's the largest player in the market, but they're at about 2,000 crores. I think Axis's ESG scheme is a little over 1,000 crores. You're at 50. Given that you've been around since 2019, I was just, sort of curious as to why that hasn't grown much, because it was almost symptomatic of the market. That's one question. And I think the second question is, look, in governance, I think India's always been ahead of the curve. So our governance requirements, whether through company law or through SEBI, have always been higher. The subjectivity comes into the social and environment rankings that you have to give companies. And I'm curious to know how you managed to do that at Quantum, because there are no clear established uniform platforms or measurements for this as yet.
Yeah, sure. Given on the size, if you look at, we are more retail focused as a fund house. So if you look at our overall AUM is significantly lower. We believe in investors buying into our funds rather than we pushing that fund to them. So we kind of educate, make them understand what the product is, and then have them buy in. So that's a very slow process overall, and therefore it takes its own time for us to grow. So on a relative basis, I think we are in line with our AUM share. So from that perspective, it does make sense. And on the second side, you talked about the governance being better, but even
so I'm saying governance is still easier to measure.
Yes.
Because, and to benchmark rather, because there are established regulations, rules, laws on that front, right?
Right.
E and S is the trickier part of ESG, not just in India, actually, currently everywhere in the world. How do you measure a company's ability to meet social goals? Even that, to some extent, I think the broad charter that independent directors and directors have in India's company law might get covered. But E is critical in being able to understand that, because that's where the big push has been in the last 2 years. So I'm just wondering how your scoring mechanism works on these two fronts.
So those two areas where we have kind of developed our expertise in terms of understanding that further, given that, as Quantum as a group, since 1996, we had emphasis on governance in any investment that we did. So on ENS, we kind of went through our own learning curve. For example, on the social side, we kind of signed up with Workforce Disclosure Initiative, a group out of UK, which is part of the Shared Action Group. They kind of advocate on what are the best practices that our company should have. So what we did, we as Quantum as a group went through our learning exercise ourselves. We kind of signed up. We said we will evaluate ourselves first, how we score on workforce practices, learn that, and take it to our portfolio companies to engage them and make them better on their workflows practices. So we signed up, we evaluated ourselves, we learned, we improved, and now we are in the process of taking it to our companies in terms of engaging with them on various social factors. Similarly, on E, we have been learning, we have been talking to various global groups, trying to understand where it is. And one fascinating thing that we found is Science-Based Targets Initiative. So if the company is low today, but they say they have a plan, and if it's vetted by someone like SBTI, the Science-Based Targets Initiative, that gives them more credibility. So we have been learning what are the global best practices and trying to not only evaluate companies, but also engage with them to make them better for a better tomorrow on these practices. So that is how we evaluate companies. So we don't only look at what is material for that sector. We try to evaluate in terms of where they are today and how they are going to be in the future. So we keep that company that rope in terms of getting it better. If they have intent, if they have shown some progress, then we kind of give them some time to even get better to what they are doing on these fronts. So we have been benchmarking to various global best practices for those sectors. We have been using the SASB framework for evaluating on the materiality aspects. So we have, of course, we kind of try to incorporate the development stage in which the companies are in the Indian scenario, and therefore evaluate them accordingly. But
Chirag, sorry to interrupt you here. I understand that you developed your own proprietary methods to be able to do this, but I'm looking at the top 5 holdings of Quantum, and the top 5 holdings, most of them are IT and finance, and it's not just peculiar to you. I think if I look at any of the other ESG funds, the largest holdings are Infosys, TCS, HDFC or HDFC Bank, Wipro. So in your case, it's Infi, TCS, HDFC, Wipro. There's Marico as the 5th one. In the case of, let's say, SPI, Magnum Equity ESG Fund, there's Infi, HDFC Bank, ICICI Bank, TCS, and then curiously, the 5th largest is Tata Motors. So, one of the questions I have is it simply that investors can't tell the difference between how is this an ESG scheme, because it seems to have finance and IT as the top holdings in its scheme, and it could be any large cap fund, that would look very similar to what any of the ESG funds look like right now.
True, but if you look at the disclosures from companies, it's largely amongst the top companies which are very good at the disclosures and their practices as well. And undoubtedly, they will make up to the top holdings. But if you look at the bottom 5 of our portfolio, I mean, not the bottom 5, but the next 5 beyond the top 5 that you said, they are very, very different exposures that you will not see in a typical equity fund. Or
such as?
If you look at our holding of Tata Communications, which is not there, which is an excellent company as far as their disclosures are concerned and as far as their practices are concerned. So there are various, and if you look at the classification as well, about 20 to 25% of the fund exposure is to the mid-cap companies as well. So we are not only looking at the large cap space, we are also looking at the mid-cap companies, which are good at their disclosures and practices. So it's not that we are barring any company. We do have a liquidity criteria. We do have the governance criteria. But apart from that, any company which is doing good on their disclosures and practices will be introduced in the portfolio. So we are not biased to any market cap or any just the large holdings that you said.
Okay, yeah, I'm just curious. Okay, when you pick, let's say, for instance, I get that the larger cap stocks, either by way of liquidity or size, end up featuring high in your scheme. But do you distinguish within the financial stocks universe or the IT stocks universe on those companies that are doing work to diversify power sources, reduce carbon footprint? Like, for instance, if you've picked as your top holding Infosys, second TCS, and then I think HDFC, and then Wipro. Are these companies where you've been able to establish that they actually have made progress in diversifying power sources? They've made progress in reducing carbon footprint, and therefore they're on the top of your holding list versus, let's say, any other large IT or financial services, companies.
Yeah, for an IT company, E is not a very big factor, but it is a factor to kind of consider. And within that, we also see, for example, we care about Infosys. They have announced a net zero targets, net zero plans. So we will analyze how credible those plans are. Are they vetted by an external source, or are they just on paper? So we will do that analysis to see that whether there is credibility in what they have announced or not. But we do look at those traits in terms of where they are today, what has been the progress, and where they are having what they are having as a target in the future. So we will analyze companies based on that. So yes, these companies are what we have as our top holding, are better today, have shown some progress, and are likely to get better, backed by a credible plan.
Actually, the only fund amongst the large ones or the old ones that I've seen that has a slightly different allocation process, at least when it comes to the top few sectors, is Axis, which seems to have given retail or retailing rather, a 20% allocation. Most others, like yours, have either in fee or TCS or top. Like I'm looking at ICICI Mutual Funds, ESG scheme. It's got Infeed, Divi's Lab, Kotak Mahindra Bank, HDFC Bank. And then the reason why I'm asking this is, please, I'm not pushing hard on your ESG portfolio, but I'm just wondering if the reason why investors are not taking to ESG schemes in a big way right now in India is because they simply cannot tell them apart from other large cap funds or multi cap funds. There isn't enough distinction. And even at the scheme end, there isn't enough disclosure to explain why these companies fit the ESG standard. They may fit the G standard a lot more than the ENS standard.
Yes, I agree. I think disclosures from the funds is an essential part, and therefore we welcome the SEBI's consultation paper where they are demanding certain disclosures from funds. We have seen that globally pan out, be it the SFDR of the EU or the Singapore regulations. They're all working towards that. When we worry about greenwashing from companies, there is also could be a greenwashing from funds, which has to be caught and cannot be allowed to pursue further. So from that perspective, I think that certain standards, like we have portfolio characteristics of a fund, you do have a portfolio ESG characteristics of an ESG fund. So what is the carbon intensity? What is the carbon footprint of that fund overall? What is the diversity metrics that the fund has? All that will allow the fund house to tell their story much better and differentiate from the traditional funds. So if you were to look at the portfolio characteristics of our fund on the portfolio carbon intensity or the diversity metrics, they do tell a story. And once it is becoming mandatory to publish those, we will publish those data out there. We do have a dashboard and which we kind of
and yet Chirag, you have about a 5% allocation to cement and cement products, 4.5% to chemicals, 2% to gas, almost 2% to pesticides, 1.5% to power, 1% to petroleum products. Now, is it simply because E is still a very difficult thing to assess in this country right now? S and G is where most of your weightage lies. G is probably the highest weightage at this point because they're clearly defined laws, regulations. Right now, ESG scheme allocations of portfolios are not truly representative of ESG investing. Can I make that argument successfully, not just for your fund, but across funds?
No, that's not true. I think look at the cement companies in India, right? Cement globally is the contributes about 6 to 8% of the carbon emissions globally. So they are a heavy emitter. But if you look at Indian companies per se, they have gone beyond, maybe because of the evolution they have been into, because of the technology that arrived when they kind of grew, as well as the practices that they have adopted. They are much better as compared to the European counterparts. And if you were to look at the EU taxonomy, these cement companies in India are classified as sustainable even by the stringent EU taxonomy norms. So they have certain thresholds above 500. They are not sustainable, and even if you look at the targets adoption, all the disclosures even from these companies, they are very, very good. They have very good disclosures. They have very good practices. The targets are very, very aggressive, and they are kind of vetted either by SBTi or some other standards. And therefore, that gives us more confidence into as what they are today and what they are going to be in the future. So even by EU taxonomy standards, so we look at all those things in terms of where they are today and how they compare globally, and if they are kind of classified as sustainable by certain stringent standards out there or not. So you talked about cement. Similarly, for chemical companies, they are better off the lot in India. They are doing much beyond their traditional remit, and therefore they are trying to be more sustainable. For example, you talk about cement. What is the alternative to cement? Right? Today, we don't have an alternative to cement. And India as a country has to grow in terms of infrastructure needs, right? And where we don't have an alternative. So are the companies going beyond their traditional remit and trying to be more sustainable or not? That is what we gauge today. And there has to be a continuous progress towards what they are doing on ESG factors. So that is what overall goes into our evaluation of companies.
Okay. So by when do you think this space will be ripe for a pickup in investments, both retail and institutional? We've discussed what some of the factors are. What we haven't discussed yet is returns. And if you can talk us through, the kind of returns you've had over the last 2.5 years, and maybe across the industry, there's a perception that ESG schemes have either underperformed or just about done as well as the benchmarks. And then, therefore, when do you think the real pickup point will be?
So you need to measure the ESG fund vis-a-vis the traditional market cap weighted indices. So either you have a portfolio which has, doesn't vet companies for environment, social governance factors, whereas you have a portfolio which is a much cleaner, greener portfolio, right? So that's some broad comparison that investors need to do today. And when you look at ESG funds vis-a-vis the traditional cap weighted indices, I'm talking about the Quantum fund right now because that's where we track very closely. That has done better than the traditional cap weighted indices. Be it the global indices India-led or be the Indian grown indices. It has done better than both of them. And if you were to bifurcate the time period into the down period that we saw because of COVID, there was a sharp fall of 40% in markets and then a sharp rebound. In each of the phases, the fund has done better than the traditional cap weighted indices. And that really tells you that it has better on the environmental social footprint as well as it has done better on performance. So when you marry both, you get the perfect portfolio that you're looking for. That is good for the planet, people, and profit, right? So it has delivered to the triple bottom line that it envisaged, and I hope that it will continue to do so in the future.
And when do you expect the real fund flow to start in the ESG space? I know you said that schemes or fund houses themselves are refining methods right now. More will be available when global standards come in. And we do know that many of the standard setting bodies are working towards that. So we should have at least one climate related standard come in the middle of next year. This is being shepherded by sort of the sustainability accounting boards, IOSCO, all of that. So do you think it will take maybe another year or so for the real pickup in India to happen between institutional funds as well as retail investor interest?
Yeah, so I think from a foreign investor perspective, we are seeing that traction built in right now. There are a lot of foreign investors who are kind of, talking to various funds in terms of how they measure ESG. They are evaluating those funds. And I think there is a lot more appetite on that front. I think once that flows start coming in, right, I think retail will also start moving in. And the disclosure requirements on funds, that will be a very helpful initiative to bring in that interest and trying to differentiate a ESG fund from a traditional fund. That is where the trigger will lie, I think. So once we see more flows coming into that domain, and once we kind of see that disclosures coming from funds, I think that will be the decider in terms of when those flows start triggering in a big way. So I think we are very close to those two things. And I think we should be on the cusp of more retail flows coming in India.
Okay, so then the last question then is, of course, the disclosure regime in India. SEBI has put out a consultation paper. I don't intend to get very technical early in the morning on a Monday, but I do want to highlight some of the things that they've mentioned in the paper and just get your broad views on exactly what you think will change from a disclosure point of view that might bring this confidence in, as you pointed out. So I think they've said at least that minimum 80% of the total assets of the scheme should be invested in ESG related securities. It's a good threshold to have because, like I said, for people like me, when I look at schemes, I'm a little confused right now as to, is this a multi-cap fund, just a large cap fund, looks the same as everything else? That's one. Secondly, more transparency on the ESG objectives by the scheme or the fund house themselves. Again, that's not necessarily uniform across mutual funds or fund houses. Investments to be designed to generate ESG sustainability impact alongside financial return. This is going to be tricky because I don't know how you're going to define some of these things. They've also said that the AMC should clearly state the intended real world outcome in qualitative terms. And finally, they've said that invest only in those securities which are issued by companies following SEBI's BRSR norms, which have kicked in this year, which is the business responsibility and sustainability requirement reporting norms that are still voluntary this year and will become mandatory next financial year onwards. What are the key changes that you expect if these recommendations were put into effect that will help improve disclosures and bring that investor confidence in?
So today we don't know if it is an ESG fund, what is the carbon intensity, the carbon footprint of the fund. We don't know what are the social metrics. We don't know what is the board diversification. We don't know what is be the carbon footprint going forward based on the plans announced by the companies themselves. So we don't know all that metrics are out there today. Is it available? Yes, it is available but to some extent there is some assumptions involved because if some company has not disclosed something, then you need to make an assumption based on certain metrics that they have. For example, in the environment footprint, what is the energy consumption, what is the fuel and power expenses, etc. That helps you estimate. That is done globally as well. Second portion is just about that 80%. Why 80%? If the other 20% is allowed as cash, that's fine. But I think if it's in the ESG fund, all securities that they own, apart from cash and cash equivalents, has to be ESG denominated, right? It has to be an ESG company per se, as defined by the fund house. Thirdly, in terms of when they ask to disclose, it has to be more granular disclosures. It has to be more standardized disclosures. Today, I don't see for a fund, you need to have a carbon intensity, carbon footprint measured by this and this formula. No, it has to be that approach to bring in comparability between funds. Today, if you don't spell out, like for companies that they have done, right? For each and every company, they have said, these are the XYZ disclosures, and this is how you define it or measure it. So that has to be given out clear and open so that there is more standardization and more comparability between funds, which is missing. And today, the BRSR somewhere allows the fund house or the companies to tell their ESG story. Today, that has to be there for a fund house also. Given it's subjective, how a fund manager sees from the other fund manager is very, very different. So a fund manager has to be able to tell their story in terms of the risk and opportunities that they see in the ESG space. That will allow to bring in more confidence and bring in more understanding for the investor. And that has to be very, very granular. Each of the allocations that they have, they need to categorize what is my emissions exposure, what is my water risk, what is my social risk. So each of the silos between E, S, and G need to be segregated and need to be analyzed at the portfolio level. And that disclosures will really help to tell that ESG story to them. and further supported by what are the engagement efforts that the fund house is having with the companies and how they are mitigating risks that are there in the fund. So all those granular disclosures will further help. I think this is a welcome step. I think it will evolve going forward. And I think as soon as we implement that, the better it is for get the confidence of the investors.
So what potential do you think for investment lies in ESG related schemes and funds? Any numbers that you have out there on, let's say, a year down the line, if all of these things start falling into place, you expect the assets under management to grow by X% or grow to this size?
No, we don't have an estimate, but if you look at the proposition,
not just for your scheme, I'm talking industry-wide.
No, it has a significant large potential because every investor at the end of the day wants to vote with their wallet, right? If they could get in a company which is better in terms of the environment footprint, better at social practices, better at governance, I think they will surely want to do it. But today they are waiting for that evidence to be there out in the open before they go and commit in a big way. So if there is a promise of that triple bottom line, better for planet, people, and profit, then I think investors will surely come in. So I think there is a much larger potential because it kind of matches with the investors' belief system, their value systems, and therefore they will be much more open to consider such kind of investment if it doesn't, or even if delivers at par with their traditional investments. So I think there is much more potential, and given the evidence that we have seen so far, and if it goes in the future as well, then I think we will see it grow multifold from where it is today.
All right, Chirag, we'll leave it there. Thank you so much for joining us this morning, talking us through this, while not really new, but still new area of investing in India. And thanks very much for being on Bloomberg.
Thank you. Thank you.